Okay, so I think we're recording right now. So what is critical in this chapter, and again, you're going to get this on the CPA exam, is the difference between capital leases and operating leases. Capital leases and operating leases. Capital leases, according to either GAAP or FASB, capital leases are treated as debt on your balance sheet. So if the company enters into an agreement, a lease agreement, and that lease agreement becomes a capital lease, that lease has to show up as a long-term liability on the balance sheet for the company. That's bad. Companies don't want to add additional long-term debt onto their balance sheets. They don't want to add additional debt onto their balance sheet. All right? So when a company goes out there and enters into a lease agreement, they're going to do everything to make sure that that lease agreement is an operating lease. Operating leases are just going to show up as an expense on the income statement. It will not show up as long-term liabilities on the balance sheet. Long-term liabilities on the balance sheet, bad. Therefore, capital leases are bad. Capital leases are bad. Okay? So what is the difference between a capital lease and a operating lease? All right? And so this is one where you may want to set up one of your flashcards to make sure, because this is definitely a CPA type of question. All right? So if you have a lease, it'll be a capital lease if it meets any one of these four criteria. If it meets any one of these four criteria, it's a capital lease. One or more, it's capital lease. Zero, it's operating lease. In a capital lease, number one, it transfers ownership to the lessor or to the customer at the end of the lease. If it transfers ownership of the building, of the equipment, of the truck, if it transfers ownership to the customer at the end of the lease, it's a capital lease. Number two, if the lease agreement contains a bargain purchase agreement. Bargain purchase means that you can buy the equipment for less than book value. You can buy the equipment for less than book value. If you can buy the equipment for less than book value, capital lease. Book value is equal to purchase price minus accumulated depreciation. So if you can buy at the time, you can buy the equipment for less than book value, it's a capital lease. Number three, the life of the lease is 75% or more of the asset life. The life of the lease is 75% or more of the asset life. Capital lease. So let's say then that the equipment has a 10-year life. The lease agreement is 8 years. Greater than 75% capital lease. And finally, number 4, if the present value of the lease payments is greater than 80% of the life of the asset, I'm sorry, the price of the asset, capital lease. If the present value of the lease payments is greater than 80% of the price of the asset, capital lease. Those 4, if you're going to go out there and you're going to take the CPA exam, better have those 4 memorized, okay? Because it will definitely come back and hit you somewhere within the CPA exam. Any questions? 4 rules, okay? Number 1, transfers ownership. Number 2, bargain purchase agreement. Number 3, 75% of life. Number 4, present value is 80% of the price. It hits any one of them, it's a capital lease. It doesn't have to hit all 4. It just has to hit one. Capital lease will go as a long-term debt on your balance sheet. Capital lease will go as a long-term debt on your balance sheet. That's what you do not want. That's what you do not want. Okay, any questions? Any questions? All right, so let's go out here then, and let's try, we'll go out here and we'll try a couple problems. And we want to then see the calculations that are necessary before we actually go out there and do the debits and credits. All right, and so let me do this and let me share the screen. And I want to try exercise, which one did I like here? Okay, so I want to go out there and look at exercise 21-1, and then I want to get to the first part first. Okay, so how about this? Take a second to read this or find this problem. Take a second to read it. Okay, so right here, on January 1st, 2017, Burke Corporation signed a 5-year non-cancelable lease for a machine. The terms of the lease call for Burke to make annual payments of $8,668 at the beginning of the year, starting January 1st, 2017. The machine has an estimated useful life of 6 years and a $5,000 unguaranteed residual value. The machine reverts back to the lessor at the beginning of the lease term. Burke uses straight line depreciation. The borrowing rate is 10% and the lessor's implicit rate is unknown. Okay, so here we go. We have our 4 rules. Okay, 5-year lease, 6-year life. The equipment has a 6-year life. So let me get my calculator here. Oh, no, let's do this on the. Okay, and I gotta jump between screens now.
Okay. I think I have my book, so I can just look it on my.
Okay, yeah, you do that then, please, so Sabrina. Thank
Okay,
you.
cool. Yeah.
Let me make this a little bit bigger. So this is exercise 2021-1. Okay, let's go out there and do part A. So we have the life of the non-cancelable lease. You know, it's 5 years. Okay, the equipment life (6 years). Okay, so the percentage of equipment life equal to 5 divided by 6, 83%. Okay, which is greater than 75%. Therefore, a capital lease. This is a liability, long-term liability, on the balance sheet. This is a long-term liability on the balance sheet. Okay, this will degrade the debt ratios. Your debt ratios are going to go down or are going to become worse because of this. All right. So the next question becomes then, hey, what? Okay, if it's going to go on the balance sheet, what's going to go on the balance sheet then, right? What's going to go on the balance sheet? So remember, they gave us a kind of a funny number here. All right. And remember, they had the lease payments. Let me look at the book here. You can look at the book here too. But they had lease payments of 8,668. Where did they come up with that number? I'm not sure. Okay. But anyways, the lease payments are 8,668. So let's do part B now. Let's do part B. These payments are going to be due, the lease payments are going to be due at the beginning of the year. The lease payments are going to be due at the beginning of the year. So we have part B. We have to set up our table. Now. So now we have, and really, you're making your first payment now. Let's do this. Year, lease payment. Present value factor and present value of lease. Has to be made at the beginning of the year, 5 years. 0, 1, 2, 3, 4. Okay. The lease payments are 8,668. we were given an interest rate of 10%. So the present value factor is going to be equal to 1 divided by 1 plus this 10% raised to the year. And let me do an absolute reference in Excel. Okay, so the present value of the lease is going to be column D multiplied by column E. Column D multiplied by column E. Copy this down. Okay, so the present value of lease payments is equal to the sum okay, so it's going to be 36144.4.
Okay.
Let me stop. Let me just write some things down. I'll give you a chance to catch up, Sabrina.
Okay, perfect.
Ah. That's bad. That's bad. Let me give you a chance to write that down. Any questions? Any questions?
No, no questions. I think it's good. And then when you put it on our D2L, we can see like again, like see what formulas we use and all that.
Yeah, yeah. And you know, in D2L, both this video and the both the video and uh, the spreadsheet will go on D2L. So make sure you check for both.
Okay, sounds good. Thank you.
Yeah. Any questions on this? All right. Now, so that's part B. That's part B. Let me look at the what do we have to do next? Okay, so what type of lease is this? Capital lease. Question B, compute the present value. Number C, all the journal entries to January 1st, 2018. Okay, so here we go. So we have to set up a general so this is going to be the general journal. We have the date, the description, debit, credit. Okay, so now we have to do all the journal entries, and this is probably going to be just for this 1 year. Okay, so therefore then on 1/1, and this is 2017 in this problem, we want to now debit equipment. And here comes the big question, for what, right? For what? We want to debit equipment for the 3614. 36,144. 36,144. And we want to credit lease liability for 36,144. Right? So we had to do all of this. We had to do all of this to do Part C. Okay? That's unavoidable. That's unavoidable. All right? So you got the equipment. Basically, you're paying with a liability. Okay? Basically, you're paying with a liability. Let's put a note down here. Lease liability is a long-term liability. All right. What else? Let's put the date down here again. What else do you have to do on January 1st? We're going to pay off part of this liability.
So we're going to take it out of cash and put it into lease liability, right?
Correct. Good. And this is going to be equal to 8668. We want to credit cash, exactly like you said. Let's put a note here. Okay, so the liability is paid at the beginning of, lease payment paid at the beginning of the year. By agreement. That's what was agreed to. Okay, let me read the question again one more time here. Okay, 6-year life, and here, you can't see this, but it's in the book, and a 5,000 unguaranteed, 5,000 unguaranteed residual value, okay? So basically, we can't go out there and use that. So now this is going to be as of December 31st. What are we going to do? Basically, this equipment is yours. You're using the lease basically to pay for this. So therefore then, your depreciation expense is going to be equal to what? It's going to be equal to the 36,144 divided by 5, because it's a 5-year lease. It's a 5-year lease. No salvage. No salvage value. So it's a 5-year lease. And so that's what your depreciation expense is going to be. And we want to credit accumulated depreciation and for the equipment. Okay. All right. Depreciation expense. This is an adjusting entry. Okay. Now, what else do we have to worry about? What else do we have to worry about now? Remember, this lease payment, instead of taking debt, you're paying with the lease. It's a long-term liability, so therefore, you're going to have interest expense. Therefore, you're going to have interest expense. So we have to record the interest expense too. And then we're going to see what happens. Oh, we're running out of time. Boy, time flies when you're having fun. All right, so we're going to have interest expense. And what is that interest expense going to be? That's going to be equal to the amount that you borrow, or the lease liability, $36,144, minus, we made one lease payment already. So we still have 4 years of lease payments or 4 years of debt that we have to worry about. And then times, remember we had to use the 10% when we did the present value problem? Present value. So this is times 10%. So the equipment cost minus one lease payment gives us 4 years of lease payments that we still have to do. We take 10% of that remaining 4 years. 10% of that remaining 4 years. 2747, and this is going to be then interest payable. Interest payable, this is going to be important now. Interest payable. This is an adjusting entry. This is an adjusting entry. Now, we have to make the lease payment. Remember, this is by agreement. We have to make the lease payment at the beginning. We have to make the lease payment at the beginning of the year. At the beginning of the year. So therefore then, on 1/1/2018, right? Let me do the lease liability. So I called it, right? Lease liability. Let me do that last. That's going to be a plug figure for me. We have the interest payable. We got to pay off this interest payable. So we have interest payable. Okay. And that's going to be equal to this 2747, we're debiting it, so we're getting rid of the lease payment. We have cash of how much we have to pay at the beginning of the year. $86.68. $86.68. Okay. Therefore, our lease liability is the 86.68 minus the 27.47. So 5920.36. Let's put some notes here. Okay, so this is lease payment paid at the beginning of the year by agreement. Okay, and the lease, let's put another, you can put another note here. Lease liability is decreased by the amount of interest payable. And let me put an arrow there. Okay, and so I think that's part C. That's part C. Not easy, not easy. Okay, does everyone see where each number comes from? Does everyone see where each number comes from?
Yeah.
We're kind of running out of time here. Any questions? Any questions?
No, no questions.
So what side of the problem is this from? Like the or the lessee or the lessor?
Oh, how about this? I forget what lessor or lessee means, but it's from the perspective of the person who is leasing the equipment. Who is that?
I would believe that's the